Welcome to the deep dive. We're here to cut through the noise, pull out the key nuggets from some pretty complex topics. Our goal, get you informed, fast, maybe with a few surprising facts, and hopefully keep you listening. And just letting you know, this deep dive is brought to you by Access Softtech, the provider of digital banking solutions. So today we're diving into something I've personally been tracking quite a bit, recent moves in Washington around stablecoins, specifically this thing called the Genius Act. It really feels like, the financial world is shifting under our feet.
It absolutely is. And our mission today really is to unpack what this act could mean for digital payments down the line. But more than that, we want to zero in on this big unanswered question it throws up, a really crucial one for where this tech is headed.
Okay, let's unpack this then. This Genius Act, it actually passed the Senate, right? June 17th. Wasn't it like 68-30?
That's right, 68 to 30. A pretty solid margin.
Yeah, pretty decisive. So what's the real weight of that? I mean, if this actually becomes law, what changes?
Well, that margin itself, it signals pretty strong bipartisan agreement that something needs to be done about regulating digital assets. If it's enacted, it wouldn't just be a nod to stablecoins. It'd be official recognition, regulation, and integration, pulling payment stablecoins right into the U.S. financial system. And what's really interesting, I think, is that it finally gives us a clear definition.
A definition, okay.
Yeah, it defines a payment stablecoin as, and I'm quoting loosely here, a digital asset that is, or is designed to be, used as a means of payment or settlement.
Right. Having that clear definition, that feels like a step forward, definitely. Getting out of that, gray zone.
It is. It's a big step. It gives a framework.
But what does that actually mean for, say, a bank or credit union thinking about using stablecoins, or even just for regular people?
It means certainty, or at least more certainty. Before, you were kind of operating in the dark, right? Risking stepping on regulatory toes you didn't even know were there.
Yeah.
Now, with a definition, with proposed rules, well, it gives institutions the confidence to maybe build services, to innovate around this, because they know the playground rules, essentially. It legitimizes the whole thing.
Yeah.
That's huge for adoption.
Okay, so it's foundational, setting the stage. But, and here's where it gets really interesting for me, even with that clarity, there's this other, maybe bigger question that pops up, isn't there? When we talk about sending a stablecoin, who are we sending it to?
Exactly. This is the knot, the really tricky part. When you look at the recipient end of a stablecoin transaction, all you really see is a wallet address. It's just, long string of letters and numbers. Looks something like 0x736F. You get the idea. 42 characters.
Like a digital mailbox with no name on it.
Precisely. So the core challenge becomes, how on earth do you know your customer KYC on that? On just an anonymous string of text?
Right. So let's think this through. If I'm a credit union member and I send stablecoins, well, the credit union knows me. That side's okay, KYCD. But the act, it doesn't seem to say much about whether that transfer is okay if the person receiving it at that wallet address is a complete unknown, does it?
It doesn't. And that leaves this gap.
A pretty big gap in accountability.
It is. It's a bit like this. Think about an ATM. When a member takes cash out, we, the financial institution, we don't really know what they do with it next, right?
Yeah, true. It just goes out into the world.
So the question this raises is, can we treat payment stablecoins the same way, like digital cash going out of the digital ATM? The act is kind of silent on this recipient identification part, and that's the sticking point. Because unlike cash, these are digital. They're recorded, often on a public ledger. But the who, on the other side, is still missing.
That ATM analogy helps, but it also highlights how different this is. Cash is physical, harder to trace globally. Stablecoins, they can cross borders instantly, but we're stuck on who's catching it on the other side. It's like chasing a digital ghost sometimes.
Yeah, it is. Look, we're definitely seeing progress overall. Regulating stablecoins is happening, and that's good. It's necessary for them to become part of the mainstream financial plumbing. But it's also crystal clear there's more work ahead, particularly around figuring out how this recipient identification piece will actually work in the real world, balancing privacy with oversight.
So the main takeaway here seems to be, okay, the Genius Act is progress. It defines things, legitimizes them. But this challenge, identifying who actually controls that recipient wallet address, that's the next big hurdle, critical for clear rules for wider adoption.
Absolutely. It's the next frontier, as you said. And maybe the thought to leave everyone with is this. As these digital assets get more woven into our finances, how do we as a society strike that balance? The balance between the privacy and innovation that blockchain tech offers and the very real need for security and accountability that we expect from our financial system, it's a tension, isn't it? And it's one that's going to keep evolving.
That is definitely something to think about. A great place to wrap up. Thanks for joining us on the Deep Dive.